Welcome back. You're here because you want to stay informed. And today we're diving headfirst into something that, well, it can feel a bit like a maze. DeFi taxes.
It really can.
And honestly, getting a handle on this now could save you some serious headaches later. And maybe keep more of your earnings, in your pocket.
Exactly. I mean, decentralized finance, DeFi, it's opened up all these incredible new financial opportunities, but the tax side, it's tricky. The rules are still catching up.
Right. Like there's not a lot of specific guidance from the IRS yet.
Very little. So tax pros, they're often stuck trying to apply old rules made for stocks or bonds, to this brand new technology. It's a bit like trying to use a horse and buggy map for a spaceship.
Okay, so that's what we're tackling today. Our mission, if you will, for this deep dive is to really break down the fundamentals. How are these DeFi activities actually taxed?
We'll look at the main categories.
Yeah, things like capital gains. That's basically profit from selling an asset.
Right. And ordinary income, which is more like earning crypto in other ways.
And also, importantly, when a transaction isn't taxed, because that happens too. The goal here is really to give you a clearer understanding of your obligations, so maybe you can navigate this space a bit better, potentially keep more of what you earn.
And to do that, we've pulled together insights from, well, quite a few places. There's a really comprehensive guide from tax attorney and CPA Andrew Gordon that was helpful.
Okay.
Plus, we looked at info on the global side, like reporting frameworks from sources like PwC, Forbes, TokenTax, the NBER, CoinLedger, and KPMG too. So a good mix of perspectives.
Great. So we're going to distill the key takeaways from all that, try and paint a clearer picture of this sometimes a murky world of DeFi taxation. So where's the best place to start making sense of it all?
I think the logical first step is just understanding the two main ways your DeFi earnings usually get classified for tax purposes. That's capital gains and ordinary income.
Okay. Capital gains. That's when you say, buy some crypto and sell it later for more than you paid. That profit.
Precisely. The profit you make from selling or disposing of an asset. That difference between the sale price and your original cost minus fees, that's your capital gain.
Got it. And ordinary income.
That's earning crypto in other ways. Think staking rewards or maybe interest you earn from lending protocols. It's not from selling the asset itself at a profit.
And both of these get triggered by what's called a taxable event.
Yes, exactly. A taxable event is basically any transaction that the IRS can tax. It could trigger either capital gains or ordinary income tax.
So it's not just selling. Receiving a staking reward, for example, that could be a taxable event too.
Absolutely. And, when we talk about capital gains, there's another really important distinction. Short-term versus long-term.
Ah, yes, how long you held the asset.
Right. If you held it for less than a year before selling, any gain is short-term. And that's generally taxed at your regular income tax rate.
Which can be pretty high.
It can, but if you held that asset for a year or longer, it qualifies as a long-term capital gain. And those usually benefit from much more favorable lower tax rates.
Got it. And yeah, we've got the 2024 tax tables here. It really shows the difference depending on if you're filing single, married, head of household. Those long-term rates can be significantly lower. Holding for over a year can definitely pay off.
It certainly can make a difference. And look, a really fundamental point here, maybe the most basic thing, is that every transaction needs to be accounted for. Every buy, sell, swap, deposit, even just transferring assets. It all needs to be listed on your tax return.
Every single one.
Every single one. And the more active you are in DeFi, well, the more transactions you have, and the more complicated that tax accounting gets.
Yeah.
It's really not something you can just ignore or approximate.
No kidding. Wow. Okay, it sounds like it gets complex fast. So maybe we should walk through some common DeFi activities and their tax implications.
Good idea.
What about something simple, like just moving crypto between wallets that you own? Like from an exchange wallet to your personal hardware wallet. Is that taxed?
Generally, no. Transferring crypto between different wallets that you personally own and control is not usually considered a taxable event.
Okay.
Think of it like moving cash from your checking account to your savings account. It's still your money, just in a different place.
That makes sense. So no tax there. But I think the guide mentioned it can still cause some issues.
It can, yeah. Mainly with record keeping, specifically calculating your cost basis.
Ah, the cost basis, what you originally paid for it.
Exactly. Which you need to know when you eventually sell or swap it to figure out your profit or loss. These internal transfers moving between your own wallets can sometimes confuse crypto tax software.
How so?
Well, the software might see crypto arriving in a new wallet and mistakenly flag it as a deposit that needs a cost basis, or even as income, when it was really just a transfer from another wallet you own. So you have to carefully review those software reports to make sure transfers are labeled correctly.
Gotcha. So not taxable itself, but watch out for how it messes with your cost basis tracking.
Okay, what about bridging assets? Moving crypto between different blockchains, like from Ethereum to Solana.
That's another common one. Similar to wallet transfers, the general consensus among tax pros is that simply moving the same asset from one blockchain to another, like bridging your USDC from Ethereum to Polygon, is not a taxable event. It's viewed as just a transfer.
Okay, that's good news.
Yeah.
Seems logical, but I feel a but coming.
There often is one in crypto tax. The but here is that many bridges aren't just simple transfers, they often involve a swap.
Huh?
For instance, maybe you bridge your Ethereum ETH over to the Avalanche network, but the bridge actually swaps your ETH for wrapped ETH, or even directly for AVAX on the other side. That swap is a taxable event.
Because you dispose of one asset, ETH, to acquire another, WETH or AVAX.
Exactly. It's treated just like selling the original asset. So the key question with bridging is, did you end up with the exact same asset on the new chain, or did you exchange it for something else in the process? That makes a huge difference. Okay, now, something ubiquitous in DeFi, gas fees, those little transaction fees on the blockchain. Do they have tax implications?
Gas fees themselves aren't like taxed as income, but they definitely matter for your calculations. They can add up, especially if you're doing a lot of transactions.
So how do they factor in?
They generally affect your cost basis or your proceeds. When you buy crypto, the gas fee you paid is usually added to your cost basis. So if you bought $100 of ETH and paid $5 in gas, your cost basis is $105.5.
Okay, so it increases your cost.
Right. And when you sell or swap crypto, the gas fee you pay for that transaction typically reduces your proceeds. So if you sold crypto for $200 and paid $10 in gas, your proceeds are $190.
So either way, they reduce your taxable gain or increase your deductible loss.
Correct. It's important to track them.
Good to know. All right, what about those exciting moments, airdrops, getting free tokens dropped into your wallet? Feels like winning the lottery.
It can feel like that, but unfortunately, the tax man usually sees it differently. The general rule is that receiving airdrop tokens is taxed as ordinary income.
Ordinary income. Oh, bummer.
Yeah. The amount of income is based on the fair market value of those tokens at the moment you receive them and gain control over them.
So even free crypto isn't really free from a tax perspective. And I've heard about people doing things like airdrop farming or points farming, trying to interact with protocols specifically to qualify for potential future airdrops. Does that change the tax treatment?
Not fundamentally, no. Those are just strategies people use to try and maximize the amount of tokens they might receive in an airdrop. When and if they do receive tokens, those tokens are still generally taxed as ordinary income based on their value at that time.
Okay, so the strategy doesn't change the tax classification of the reward itself. Got it. Let's shift to something a bit more complex. Collateralized DeFi loans. Say I put up some ETH as collateral to borrow some USDC stablecoins. Is putting up the ETH a taxable event?
Generally, no. Just providing collateral for a loan, like putting up your ETH to borrow USDC on a platform like ASA or a compound, does not trigger a capital gain. You still own the ETH.
Okay. And the loan itself, the USDC I receive, is that income?
No, the loan proceeds aren't considered taxable income either because you have an obligation to repay it. It's a debt, not earnings.
Okay, that part sounds straightforward. Borrowing isn't taxed. But then the guide mentioned something about repayments, that repaying the loan is always a taxable event. That sounds weird. Why would paying back a loan trigger tax?
It does seem counterintuitive, doesn't it? But here's why. You're typically repaying the loan using other crypto assets. For instance, you might use some of your BTC holdings to repay the USDC loan.
Ah, so you're disposing of the BTC to pay back the debt.
Exactly. That disposal of the BTC, or whatever crypto you use for repayment, is a taxable event. You'd have a capital gain or loss on that BTC based on its value when you used it for repayment compared to its original cost basis.
Wow. Okay, that makes sense now. So the act of repayment itself isn't the trigger. It's the disposal of the asset used for repayment. That's tricky.
It is. And finding the cost basis for the specific crypto units you use for repayment can be really challenging, especially if you acquire them at different times and prices. This is why borrowing stablecoins is often simpler, accounting-wise, than borrowing more volatile crypto.
Right. And what about the interest paid on these DeFi loans? Can you deduct that?
Maybe, but usually only in specific circumstances. If the loan is clearly part of a formal trade or business activity, the interest might be deductible. For most individuals just using DeFi, though, it's generally not deductible.
Okay. So borrowing has layers of complexity. Now, the scary part, what if things go south? What if the value of my collateral drops and the protocol automatically sells it off liquidation?
That's a really important scenario to understand. Automatic liquidation is considered a taxable event. Even though you didn't actively choose to sell, the protocol sold your collateral on your behalf.
So it's treated as if I sold it at that moment.
Yes. The example mentioned was Jared putting up UNI and SOL for a loan. If the price dropped and the protocol sold his UNI and SOL to cover the debt, that sale triggers capital gains or losses for Jared, depending on his original cost basis for that UNI and SOL.
Ouch. So you lose your collateral and potentially owe taxes on the sale, even if you lost money overall on the position. That's a double whammy.
It absolutely can be. It highlights the risks involved.
Okay, let's talk about ways people earn in DeFi. Liquidity pools and staking are huge. You put crypto into a pool, maybe pairs of tokens, and earn trading fees or other rewards. How are those rewards taxed? And I guess we should clarify, staking can mean different things here.
Right. Let's talk about providing liquidity first. When you deposit crypto into a liquidity pool, LP, and earn rewards, often paid out as a portion of the trading fees generated by that pool, those rewards, well, the guidance isn't perfectly clear. Yeah. It could potentially be treated as ordinary income when you receive the rewards based on their value at that time. Then, if you later sell those reward tokens, you'd have a capital gain or loss on the sale. Some argue it could also be viewed differently, perhaps more like capital gains from the start, depending on the mechanism.
So it's a bit ambiguous. Ordinary income seems like the more common treatment I've heard.
That tends to be the safer, more conservative approach. Many treat rewards as ordinary income upon receipt, and the same general logic applies if you're doing single-sided staking, just providing one type of token to earn rewards.
Okay, so likely ordinary income when received, then potential capital gains later. This lack of clear IRS guidance is a recurring theme, isn't it?
It really is. It creates uncertainty for users and tax preparers alike.
What about yield farming? That's where you take your LP tokens, the receipt you get for providing liquidity, and stake those somewhere else to earn even more rewards. Is that just more the same tax-wise?
Pretty much, yes. The additional rewards earned through yield farming generally follow the same potential tax implications as the initial LP rewards. So, likely ordinary income when you receive those extra yield farming tokens based on their value then.
Got it. Now, the other kind of staking, proof of stake consensus, like staking ETH or SOL directly on the network to help validate transactions and secure the blockchain, earning rewards for doing so. How are those rewards taxed?
That's generally clear. Rewards earned from proof of stake validation are typically treated as ordinary income. The income is measured by the fair market value of the rewards at the time you gain dominion and control over them, basically, when they become available for you to use or transfer.
Okay, ordinary income upon receipt. That seems consistent. But what about liquid staking, where you stake, say, ETH, but you get back a liquid token like Lido's Steth or Rocket Pool's REITH, which you can then use elsewhere in DeFi while still earning staking rewards. Does that complicate things?
Oh, it definitely adds layers. Most tax professionals currently lean towards viewing the initial swap ETH for Steth, for example, as a taxable event.
So disposing of ETH for Steth triggers a potential capital gain or loss right there.
That's the likely interpretation, yes. And then, when you eventually want your ETH back and swap the Steth back to ETH, that's another potential taxable event.
Wow.
And on top of those two potential taxable events, the staking rewards you earn while holding the Steth, which might also be paid in Steth, are still treated as ordinary income when received.
Goodness. So liquid staking could involve taxable events at the start, taxable events at the end, and ordinary income tax on the rewards earned in between. That's intricate.
It really highlights how complex DeFi interactions can become from a tax perspective.
No kidding. Okay, one more common activity. Leverage or margin trading in DeFi. Borrowing funds to trade with more capital. How does tax work there?
Similar to collateralized loans, the initial act of borrowing funds for margin trading isn't taxable income. You borrowed it, you have to pay it back.
Right. Creates a debt.
But just like repaying those collateralized loans, anytime you use your existing digital assets to make a payment towards that margin loan, that disposal of assets is typically a capital gains taxable event.
Okay, same principle as loan repayment and the actual trading profits.
Any profits you make from the trades executed using those borrowed funds are, of course, subject to capital gains tax, short-term or long-term, depending on how long you held the assets you traded.
Makes sense. You're buying and selling, generating gains or losses. What about the interest paid on margin loans? Any chance of deducting that?
Again, it's similar to other DeFi loan interest. It might be deductible, but usually only if the trading activity constitutes a formal trade or business, or if you qualify for and elect what's known as trader tax status, which has specific requirements. For the average person margin trading in DeFi, deducting the interest is unlikely.
Okay, so across the board, it feels like the message is almost every action beyond simply holding can trigger a taxable event, and the accounting gets complex fast.
That's a very accurate summary.
So, with all these potential taxable events swirling around swaps, rewards, loan repayments, liquidations, how does someone actually figure out what they owe? It honestly sounds like a potential nightmare.
You're not wrong. It can be incredibly complex. And this is where, I really have to emphasize how strongly we recommend seeking professional help. Try to DIY complex DeFi taxes. It's risky.
Why so risky? Just making mistakes?
Mistakes, yes, which can lead to underpaying taxes and facing IRS penalties and interest. But also just the sheer record-keeping burden. The single biggest risk for DeFi users is simply not having meticulous, accurate records of every single transaction.
So, for anyone doing more than just buying and holding a couple of things, DIY is probably not the best idea.
For significant DeFi activity, I'd say absolutely not. Proper reporting requires accounting for every single buy, sell, trade, reward, transfer, deposit, everything, with dates, values, fees, and cost basis information.
I know there's specialized cryptocurrency software out there now. Can't that just handle it all?
That software is definitely a valuable tool. It can help aggregate data from exchanges and blockchains, and it can perform many of the calculations. But even the best software can struggle with the real complexities and nuances of DeFi. Things like accurately identifying transfers versus taxable deposits, handling LP tokens correctly, tracking cost bases across complex yield farming strategies. The software can make errors or misinterpret things.
So it's a starting point, but not necessarily the final answer.
Exactly. You'll likely still need a human expert, someone familiar with crypto and DeFi taxes, to review the software's output, make corrections, handle the really tricky parts, and ensure accuracy, especially with the more advanced DeFi stuff.
That makes sense. And something else adding complexity, Forbes mentioned this starting January 1st, 2025. The IRS is requiring cost basis tracking using the per wallet accounting method. What does that mean?
Yeah, that's a significant change. Historically, many people used methods like FIFO, first in, first out, or LIFO, last in, first out, across their entire crypto portfolio. Per wallet accounting means you have to track the cost basis of assets separately for each digital wallet you control.
Whoa, so if I have crypto on an exchange in a hardware wallet and in a software wallet, I need to track the basis for the assets in each one independently.
That's the requirement, yes. It adds another layer of complexity to tracking. It means you really need to be using platforms, wallets, and tax software that explicitly support this method to stay compliant.
Okay, good to know. Another thing that comes up is holding crypto overseas. If I use a non-U.S. exchange, are there special reporting rules? I think I've heard of FBAR.
Yes, FBAR, the Foreign Bank Account Report. This is filed with FinCEN, the Financial Crimes Enforcement Network, not the IRS directly. If you have financial accounts, which may include cryptocurrency accounts held on foreign exchanges.
Like Binance.com, KuCoin, Bitfinex.
Exactly. Those are common examples of foreign-based exchanges. If the total aggregate value across all your foreign financial accounts exceeds $10,000 at any point during the calendar year, you might be required to file an FBAR.
$10,000 total across everything.
Yes. Now, as of early 2025, FinCEN hasn't issued final definitive guidance stating that crypto must be included on the FBAR. However, the expectation and the conservative advice from most tax professionals is that it will be required, likely soon. So the cautious approach is to assume foreign crypto accounts count towards that $10,000 threshold and file an FBAR if you meet it. Better safe than sorry.
And if you don't file when you were supposed to, what happens?
The penalties can be severe. For non-willful violations, basically you didn't know or made an honest mistake, penalties can be up to $10,000 per violation, per account, per year. For willful violations you knew you should file and didn't it, the penalties can be the greater of $100,000 or 50% of the account balance per violation.
Yikes. Okay, that's definitely not something to mess around with. Is FBAR the only form for foreign assets? I saw a mention of Form 89382 too.
Right, Form 8938, Statement of Specified Foreign Financial Assets. This one is filed with the IRS as part of your regular tax return. It also requires reporting foreign financial assets. including potentially crypto held in foreign accounts, but it has different reporting thresholds based on your filing status and residency.
So you might need to file one or the other or both.
Exactly. Filing Form 8938 does not relieve you of the FBAR requirement if you meet the criteria for both. They are separate obligations.
Good to know. What if someone listening realizes, uh-oh, I probably should have reported crypto income or gains in past years, but I didn't. What can they do now?
The best course of action is usually to amend their previous tax returns. You can file an amended return, Form 1040X, to report the previously omitted income or transactions and pay any tax due, plus interest. CoinLedger actually has a pretty helpful guide on the process for amending returns specifically for crypto.
So fix it proactively rather than waiting for the IRS to potentially find it later.
Absolutely. Voluntary disclosure and correction are almost always better than dealing with an audit or enforcement action down the road.
Makes sense. Okay, backing up just a bit, we talked about capital gains. Can you just quickly recap the basic calculation?
Sure. The fundamental formula is proceeds minus cost basis equals your capital gain or loss.
Proceeds being?
Proceeds are what you received when you sold or disposed of the crypto, minus any transaction fees or commissions you paid for that specific sale.
Okay. And cost basis?
Cost basis is essentially what you originally paid to acquire the crypto, plus certain other costs associated with acquiring it, like the gas fees we discussed earlier.
Simple formula, but like we said, tracking that cost basis accurately across potentially hundreds or thousands of DeFi transactions, that's the real challenge.
Precisely. And getting it wrong means you could easily end up overpaying your taxes or underpaying and risking penalties. Careful tracking is key.
Definitely. Now, we've been focused mostly on the U.S. situation, but you mentioned global efforts earlier. This crypto asset reporting framework, CARF, sounds like a big international push.
It really is. CARF was developed by the OECD, that's the Organization for Economic Cooperation and Development, a group of mostly developed countries. They adopted it back in June 2023.
And the goal is?
The goal is basically to create a standardized global system for tax authorities to automatically exchange information about taxpayers' crypto asset transactions. It's about increasing tax transparency across borders.
So making it harder for people to hide crypto assets or income from their home country's tax authority by using services in other countries.
That's the core idea, yes.
Yes.
It covers reporting of transactions involving crypto assets and also certain e-money transactions. The main implication for listeners is that tax authorities worldwide are likely going to get a lot more information about your crypto activities, regardless of where those activities occur.
Okay, a global standard for sharing crypto tax info. And the EU is doing something similar with DAC8.
Yes. DC8 is the EU's version, the Eighth Amendment to their Directive on Administrative Cooperation. It closely aligns with TrueRF and also ties into their MiCA regulations, the Markets in Crypto Assets regulation. It mandates the automatic exchange of information on crypto transactions between EU member states.
When does that kick in?
EU countries have until the end of 2025 to write DC8 into their national laws. Most of its provisions will then take effect on January 1st, 2026, with the very first reports covering the 2026 tax year due from crypto providers by May 31st, 2027.
And you mentioned DC8 might even go further than CRF.
It does in one key aspect, extraterritorial scope. DC8 can require crypto service providers located outside the EU to report information on crypto transactions involving EU residents if those providers serve EU clients. That's a pretty broad reach.
Wow, yeah, that definitely widens the net. And it looks like tons of countries are already moving to implement these frameworks. You listed Australia, Denmark, Germany, Jersey, Lithuania, the Netherlands, New Zealand, Singapore, Switzerland, the UK. Even the US is planning to align.
Exactly. It's a coordinated global rollout. Australia's consulting. Denmark's got a bill. Germany's got the Crypto Asset Tax Transparency Act draft. The UK has draft regulations out for consultation. They're all aiming for implementation around 2026 generally.
So the direction of travel is clearly towards much more comprehensive, automated, cross-border reporting of crypto transactions for tax purposes.
Without a doubt. The era of crypto being completely opaque to tax authorities is rapidly coming to an end.
One interesting detail you noted, the original ARFR draft proposed requiring reporting of wallet addresses when crypto was transferred to unhosted wallets, like personal hardware wallets. But that got removed.
It did. That was a point of significant discussion and concern from the industry about privacy and feasibility. In the final OECD rules for CRFA, that specific requirement to report recipient wallet addresses for transfers to unhosted wallets was removed.
But the core reporting requirement for exchanges and other providers remains.
Yes. The core requirement is that reporting crypto asset service providers RCASPs. Think exchanges, brokers, some wallet providers will have to collect detailed information about their customers and their transactions and report that information annually to their local tax authority, who can then exchange it internationally under CARF and DSEA.
Okay, so a massive global shift towards transparency. But even with these frameworks, taxing crypto isn't suddenly simple, right? The KPMG report highlighted some ongoing challenges.
Absolutely not simple. One of the fundamental problems, as KPMG points out, is still the lack of a single internationally agreed-upon definition of what cryptocurrency even is for legal and tax purposes.
Right. Is it property, a commodity, a security, currency?
Exactly. Different countries treat it differently. Some see it as property, like the U.S. generally, others as a financial instrument, some as a commodity, El Salvador even as legal tender. This lack of legal harmony makes consistent international reporting and tax treatment really difficult.
If countries can't even agree on what it is, agreeing on exactly how to tax every type of transaction globally seems challenging.
It's a major hurdle. And then you still have the issue of the pseudo-anonymous nature of many blockchain transactions. While Torov increases reporting from intermediaries, tracking the flow of funds once they move off those platforms, especially through mixers or privacy coins, remains difficult for authorities.
And that anonymity, or pseudo-anonymity, is part of what has tax authorities concerned about potential tax evasion, isn't it?
It certainly fuels their concerns. Authorities see the potential for undeclared income and gains, and that's a big driver behind initiatives like CORF and increased domestic reporting. The U.S. Treasury, for instance, has projected a pretty significant tax gap in the future, partly attributable to crypto noncompliance.
And we're seeing the U.S. response with things like the infrastructure bill's reporting requirements and the upcoming Form 1099-DA, which will require brokers to report crypto sales and potentially other transactions directly to the IRS and taxpayers.
Correct. That's all part of the push for greater visibility and compliance domestically, mirroring the international push with CORF.
But it's interesting. While many large economies are tight in reporting, the overall global approach isn't uniform, is it? Some places seem more welcoming to crypto innovation than others.
Definitely not uniform. You have some jurisdictions actively trying to attract crypto businesses with clearer regulations or favorable tax treatment. Then you have others that are more cautious or even restrictive. And sometimes you see conflicting signals, like the IMF, occasionally including conditions discouraging crypto adoption and loan agreements to certain countries. It's a real patchwork quilt globally.
It is. But looking further ahead, could the technology itself, blockchain, actually offer solutions? The KPMG report hinted that blockchain might eventually improve tax reporting.
It's a fascinating possibility. While blockchain currently presents challenges for tax authorities due to decentralization and pseudo-anonymity, the underlying technology, a transparent, immutable ledger, could potentially be leveraged for better tax systems in the future. Imagine, hypothetically, a system where tax obligations are calculated and potentially even settled in near real time directly on a blockchain as transactions occur. Or a global registry where authorities could verify tax compliance more easily.
Yeah.
It's very futuristic, but the report suggests the tech itself isn't inherently anti-transparency. It could be adapted.
Using the complex technology to eventually simplify compliance. An interesting thought. Okay, well, this has been a really comprehensive deep dive. Let's try and boil it down to the key takeaways for everyone listening.
I think the absolute main takeaway is that DeFi taxes are complex, period. And the rules are still evolving. It demands careful attention and a really proactive approach. You can't just wing it.
Absolutely. And really understanding the difference between a taxable event like selling, swapping, receiving most rewards, repaying loans with crypto, and a non-taxable event like buying and holding or transferring between your own wallets. That's fundamental.
And crucially, remember, this isn't just a U.S. issue anymore. The global landscape is shifting dramatically with TRF and DSEA coming online. Expect much more information sharing between countries in the coming years.
So, while hopefully this discussion gave you a good foundational understanding of the key issues and activities,
given all that complexity, the changing rules, the global dimension, getting personalized advice from a qualified crypto tax professional who understands your specific situation is really indispensable.
couldn't agree more. It's just too intricate, and the stakes are too high to rely solely on general information.
Exactly. Tailored advice is the way to go.
All right, so maybe a final thought to leave our listeners with, something to chew on. As DeFi keeps innovating at this breakneck speed and regulators globally try to keep pace, how will we all, individuals, businesses, even governments, navigate this shifting financial and legal landscape? How do we balance ensuring compliance with fostering innovation and maximizing the genuine opportunities this technology offers?
That's the billion-dollar question, isn't it? Balancing those forces will shape the future of finance and regulation. Definitely something to keep thinking about.